The U.S. car price bubble has burst, and according to Bloomberg, fear of an impending collapse is gripping the auto industry because demand is rapidly disappearing due to the impact of soaring interest rates on auto loan costs. This time around, not even the electric vehicle market is going to be immune. Believe it or not, right now, Tesla prices are $5,000 cheaper than the average U.S. car, and leading industry experts are telling manufacturers, dealers, and lenders to brace for some huge price crashes in 2023 as unsold inventory starts to pile up. But if you think that means you'll be able to go out there and get yourself a brand new vehicle at super cheap costs, we're sorry to break it to you, but that won't be the case for the foreseeable future. Affordability issues are likely to persist throughout the year, and in today's video, we will tell you why. We have a lot to cover, but before moving on, we'd like to ask for your support with a thumbs up, and don't forget to subscribe. The value of new and used cars is about to come crashing down after 2 years of record highs, according to big names in the auto industry. After skyrocketing almost 80% from 2019 levels, used car prices are sliding at the fastest pace since 2011, data from auto lenders shows. New car prices are seeing more modest declines, but they're still significant after years of robust price growth. There is nowhere for these prices to go but down, said Greg Marcus, the executive vice president of Auto Lenders, the parent company of New Jersey's largest used car dealership chain. Marcus notes that part of the decline that's already taking place is consequential. First of all, these increases were not sustainable, and most of them were driven by buyers at used car auctions overpaying for the limited supply of used vehicles, he explained. Another major reason for the drop is the increasing supply of new cars now hitting the market. During 2021 and 2022, it was the lack of new car inventory that kept pushing prices to record-breaking levels. Part shortages, especially for semiconductor chips, had choked off production of new vehicles last year, causing the lowest level of full-year U.S. new car sales in almost 2 decades. But all of that has started to change in recent months. Automakers are reporting more supplies of the chips they need, and manufacturing is finally recovering. This has certainly taken a toll on the used car market, which has already seen a 15% price crash so far this year, according to the Manheim Price Index, marking the biggest ever year-over-year decline since the firm began tracking this data. SUVs were among the vehicles posting the biggest price drops, falling 16.6%, while mid-sized cars fell 15.8% and luxury cars fell 15.2%. Analysts at Edmunds say that the average price of a used car is currently standing at $29,533. That's a decline of $1,600 from its peak. In contrast, last month, average new car prices reached a new high of almost $50,000. But a 5% decrease is expected by the end of March, the analyst said. New and used car prices likely will decline through most of 2023, added Pantheon Macro chief economist Ian Shepherdson in a recent note, pointing out that profit margins for auto dealers rose faster than anywhere else during the pandemic and have much further to fall as supply chain concerns abate. The damage is spreading to the electric vehicle market. Believe it or not, today, Tesla's Model 3 sedan now sells for $4,930 less than the average new vehicle sold in the U.S. That's the cheapest price Tesla has ever had relative to the typical U.S. vehicle, Bloomberg reports. It's a similar story for Tesla's more expensive Model Y sport utility vehicle, which started off the year with a staggering $13,000 price crash. Tesla prices are collapsing hard and fast, and this is reverberating across the EV market. In the past couple of weeks, Ford Motors' electric Mustang Mach-E saw a $5,700 price decline, while Lucid Group Inc. is now selling vehicles for up to $7,500 less than original listing prices. Rivian Automotive is in such deep trouble, it's announced more layoffs this month. General Motors is now considering delaying the launch of electric versions of its Chevrolet Blazer and Equinox SUVs as the industry cools down. Or as a Morgan Stanley analyst Adam Yunus puts it, the EV market may be entering the shakeout phase. Because prices have spiraled so rapidly in all sectors of the market in recent years, fear of a sharp car price collapse is gripping the auto industry, according to a Bloomberg report. Executives are starting to sound the alarm about the impact double-digit drops of 40, 50, and even 60% could have on manufacturers' and lenders' bottom lines in 2023. If that fear is realized and prices plummet, it will be detrimental to automakers and their in-house lending units, which likely will have to write down the value of lease contracts that had assumed vehicles would retain greater value, the report highlighted. Moreover, Forbes is reporting that car prices paid by wholesalers last month fell the most on a yearly basis since at least the late 1990s. The problem is, lower wholesale prices aren't necessarily making vehicles more affordable for buyers. Rising interest rates are counteracting the effect of less expensive cars, limiting consumer demand. On Tuesday, CarMax, the nation's largest pure used car dealer, warned that the combination of high interest rates and higher car payments is creating an affordability problem on the consumer side, which can lead to massive piles of unsold inventory in the coming months. That same concern was shared by Dale Pollock, the executive vice president of Cox Automotive, America's largest auto action company. 6 months from now, there will be huge, if not unprecedented, levels of wholesale supply in the market, he said. Cars are already coming in, but they aren't selling. With wholesale inventory expected to rise further, unsold supplies will be even larger in the months ahead. Since March 2022, the Federal Reserve has already hiked interest rates in an attempt to curb runaway inflation. At the beginning of last year, the federal funds rate sat at around 0%. Today, it sits at 4.58%. This has resulted in a dramatic increase in auto loan rates, both for used and new vehicles. According to industry data, the average rate for a 60-month loan on a new car jumped from 3.85% in January 2022 to 5.27% in January 2023. This 35% increase in the average interest rate represents a difference that can change the affordability equation for millions of buyers, particularly considering that the rising costs of living have not coincided with higher wages, which have not seen a meaningful increase over the same period of time. This means that workers are spending a larger portion of their income on goods and services, leaving less room in the budget for car payments and increasing the challenge of saving for a down payment. Such affordability issues are keeping Wall Street and industry analysts on high alert for signs of a demand destruction scenario for the U.S. auto industry, especially now that a new economic downturn is unfolding. The latest increases in interest rates led to upticks in average monthly payments of $785 for new cars and $661 for leases, Cox said. The longer-term concern is that this causes what is produced to skew even more towards luxury and away from affordable price points, which means even the U.S. vehicle market has a long-term affordability issue, Polak added. And even though everyone is expecting the moment when car prices get back to down-to-earth levels again, the ongoing price drops actually have a negative effect on car buyers by reducing the value of the vehicle they hope to trade in. Cox shows that the average trade-in value in January was down nearly $3,000, or 11%, to $22,605 from the record high hit in June of 2022. That drop in the value of trade-ins could also be a headwind on car prices by reducing what buyers are able to pay. At the same time, we still have nearly 17 million car owners that own vastly overpriced used vehicles. More than half of these cars are financed, potentially resulting in many car owners with car loans that are or will be underwater very soon. According to Moody's, some 9.3% of auto loans extended to people with low credit scores are at least 30 days late. That's the highest rate since 2010, the Wall Street Journal reports. The households that were on the financial ledge to begin with might have been tipped to the point where it's hard to keep up on the car loan and everything else, and people have to make some very hard decisions, says Pamela Fooey, a professor at Cardozo School of Law who studies consumer law. And as the journal notes, if job losses increase, many more consumers might find themselves unable to keep up with the record amounts of debt they took out in recent years. This could trigger a wave of repossessions that'll be unlike anything we've ever witnessed. Everywhere we look, we can find new pieces of evidence that prove things are looking increasingly uglier for the U.S. auto industry. For many consumers, the dream of owning a car has turned into a nightmare of debt and default as they struggle to keep up with payments on loans they simply can't afford. At the end of the day, this is a stark reminder of the fragility of the American middle class and the dangers of an economic system that relies on debt to fuel consumption. As more and more borrowers default on their loans, lenders will suffer significant losses and may be forced to tighten their lending standards, making it harder for consumers to access credit. Meanwhile, automakers are likely to struggle to weather the storm as demand for new cars decreases and dealerships struggle to sell their existing inventory. Ultimately, the ripple effects of all of this will be felt throughout the entire economy, given that fewer auto sales can lead to lower employment in the auto industry and reduced consumer spending. The truth is that the auto loan crisis is a ticking time bomb that threatens to explode, unleashing economic devastation on a scale not seen since the Great Recession. Thank you for watching.